So I want to talk to you about QE a little bit and sort of the macro response that we might see over the next couple of months, because the Fed obviously says it needs to reduce the balance sheet, that it's going to hike rates. Some people within the Bitcoin space and macroeconomists say, hey, that won't happen, or they're going to have to ease off the gas pedal because the market can't handle it. Others say the inflation's going to run way too hot. So what do you think is going to happen, and how's that going to impact equities and Bitcoin?
So I think the Fed is going to try to tighten mildly until something breaks. And even before this war, I mean, that's you had the falling PMI environment and you had the Fed try to tighten into a falling PMI environment, which is actually kind of unusual. So normally the Fed tries to tighten into a strong market. They
Yep.
say, okay, the market's strong. This is our chance to get off zero. This is our chance to stop doing QE. Um, and right now, because of high inflation, they're trying to do it, or at least talking about trying to do it, while PMIs are actually falling. And so that's kind of the big challenge. That was, pre-war, that was my big risk off concern is all of that happening. Now the war as another factor, because if you have high gasoline prices and high energy prices in general, that's less money that consumers can spend on other areas. And so you have this risk off environment. Now, the Fed has a dual mandate where they want to have what they call stable prices, which they define as 2% inflation based on the way that they measure inflation. And they also seek low long term employment. And right now, the employment measures they look at are pretty strong, while inflation is obviously way above their target. And that's that hurts a lot of people right now. Gasoline prices going up, wheat prices going up. The problem is a lot of that is outside of their control. I mean, they've contributed to it by having very easy money conditions, but a lot of this is due to supply things we talked about before. But what they're going to essentially, they're trying to do is rein in that inflation to regain confidence in the market that they have a handle on price stability. And the challenge there is that that's hard to do when you have a decelerating economy, when you have an economy that is either no longer it's either growing at a slower rate or it even starts to go flat or even shrink mildly. It's very hard to tighten monetary policy into that environment. And so I've been generally taking the under on estimates, so I don't have a specific price range or for what they're going to get the Fed funds rate up to. But up until this war, you had investment banks kind of tripping over each other to price in more and more rate hikes. They were like playing a game of like who could be the most hawkish. And I was saying
Yeah.
like I don't know what number we're going to get to, but I'm going to take the under on this consensus. And that got more complicated by the war. And so, you know, the Fed's not going to stop tightening if markets, when indices fall 15%. They're not going to stop tightening when you just have dislocations. It's really about watching what the credit market does. Do junk bond
Mhm.
markets freeze up?
Right.
Do high yield spreads, high yield bond spreads, their yields compared to treasuries, do they widen sharply? Does that market become a liquid? Is the treasury market becoming a liquid? Those sort of things could eventually cause the Fed to reverse course and not continue tightening, and to even, say if they stop QE, they could restart QE. I still think we're a little bit while away from those. But if you do start to get severe dislocations and recession indicators, and specifically problems in the credit market, that's when I would see the Fed probably pull back. So right now, my base case is that they at least try to tighten. It's kind of like the old college try. Like Powell wants to be like, we tried. We tried
Hmm.
to. We didn't just ignore it. We tried to tighten into it. And one of the research I've done over the past few years is that this period looks a lot like the 1940s
Right.
rather than the 1970s. And so in the 1970s, you had high inflation, but you had very low debt. And so
Hmm.
you could raise rates sharply to try to contain that inflation. And you would cause a recession, but you wouldn't cause like a depression. You wouldn't cause like a global insolvency event.
Yeah,
In the
like a
40s,
bust.
exactly. But in the 40s, because you had so much public debt because you were fighting the war, federal debt to GDP was over 100%. They couldn't raise rates despite the fact that they had high fiscal related, commodity war inflation. And so they said, you know what, we're going to hold rates at zero anyway, even though inflation's running hot. And so my base case has been low rates, but high inflation. And so that's what we've been seeing now. And I still think that's going to continue for a long period of time. I think the 2020s, when we look back on it, will be a decade where inflation levels were on average much higher than interest rates around the world.
Wow. Well, shifting gears a little bit, I just wanted to say that recently I watched your interview on what Bitcoin did about wealth inequality. And it was fascinating because It is so nuanced and people just want to blame it on the money printer, but you dug into so many different aspects of how wealth inequality is actually caused, and then obviously how Bitcoin could perhaps level the playing field a little bit. So I wanted to know if you could summarize a little bit of your outlook on, could Bitcoin be a solution to some of the wealth inequality that we see, and could it redistribute some of the wealth that has made life so hard for the average American?
Mainly what Bitcoin does is that it's fair and undilutable, right? So it doesn't necessarily on its own fix, I don't like to call it wealth inequality. I like to call it wealth concentration because
Hmm.
no one should really expect wealth to be equal.
True.
But when you start to see extreme levels of concentration, especially if they're driven by misguided policies that help, feed that concentration, that's when it becomes a problem. You usually get rising populism. You get a breakdown of the
Hmm.
social contract. People rightly perceive that it's kind of rigged against them, the whole system.
Yeah.
And so that's the kind of wealth concentration I talk about as being a problem. And Bitcoin can address that in the sense that, unlike fiat currencies, it can't be diluted, right? So it gives people more control over their own savings, assuming the Bitcoin network continues to be successful, widely adopted, and working as intended. And so that gives people that kind of self sovereignty. I think it most helps people in developing markets and in emerging markets and in refugee situations, right? So in many cases, it gives tools to the most vulnerable among us. I think in that way, it can help global wealth concentration. And then in developed markets, it can kind of reduce financialization, this kind of Cantillon effect that we've kind of built up over decades, and give more power to the people in terms of saving and appreciating scarce asset. And so in that sense, I do think it's a factor that can contribute to just kind of better wealth concentration aspects going forward. But I think it's one piece. Basically, in order to not have the extreme wealth concentration, you need a lot of changes compared to what we've seen over the past couple decades. So I don't think it's like a silver bullet, but I think it's a really important tool that can act as a catalyst and act as kind of an initial thing for people to use to kind of go around the existing system, kind of build their own financial system on the side and have more control over their own payments and their own savings.
There are Bitcoiners who feel strongly that oil is going to eventually be priced in Bitcoin. Do you agree? And if so, how do we get there?
So basically, it obviously has a connection to energy in the sense that oil and gas can for example use their spare they're basically their if you collect oil out of the ground, if you have associated natural gas and you don't have a pipeline for it, you can, for example, instead of burning that natural gas into the atmosphere, you can use it to mine Bitcoin, right? So it's already a connection between energy and Bitcoin, and specifically Bitcoin mining. Now, entities that don't want to sell in dollars could sell in a number of different other payment channels. They can sell it in euros. They can trade it for gold, right? You see this sometimes in
Mhm.
places like Iran or other countries that have to kind of go around the system. They're kind of, they're sanctioned, but there's still some trading partners that want their stuff. And so they have to make these other types of deals to go around the system. And Bitcoin, as both an asset and a payment channel, is obviously interesting for any sort of exporter, let alone an energy exporter. And so, if the Bitcoin network continues to get bigger and bigger and more stable, it can be used for either a payment system or a store of value system for some of these larger entities. And so, it's a natural fit. The caveat right now is that they don't like the volatility of Bitcoin, but you can use Bitcoin the network without even necessarily using Bitcoin the asset. Like we're seeing with Strike, for example, with smaller payments, you can do similar things on a larger scale, especially as the network grows. And so I wouldn't be surprised one day to see more commerce happen in the Bitcoin network, especially if we continue these structural adoption trends we've seen over the past 5 to 10 years.